again, everyone. Let's take a look at continuation patterns. First up is the triangle.
So what is a triangle pattern?
A triangle pattern shows the price action trading in a narrowing or coiling range. The pattern contains at least two highs and two lows that create the shape of a triangle when connected.
Sounds pretty straightforward.
There are three different types of triangles: ascending, descending and symmetrical. All three are continuation patterns in the right circumstances.
Okay, so what are the differences between them?
Well, let's look at ascending triangles first. So an ascending triangle is a long-term bullish or bearish formation. It is normally bullish though, so we'll describe how one of these forms. Several things need to happen. First, a bullish trend needs to exist and precede the pattern.
Okay, that's fairly easy to spot.
Second, at least two highs in price need to be reached at a horizontal. This is the same as an emerging horizontal resistance line. It's as if a really big sell order has been placed to be filled at this price, and no matter what the bulls do, they cannot push the price beyond it.
Right, so the price isn't pushed any higher.
Exactly. Third, there needs to be higher lows forming. This might already be the support in the preceding upward trend line. If this line breaks, then it's not a valid ascending triangle pattern. The pattern squeezes the price and places a time limit on its completion.
Okay, so the third thing that needs to happen is that higher lows need to be formed. Got it. It's now starting to look like a triangle.
We are nearly there. Finally, we are looking for the breakout above the upper resistance level to confirm the pattern.
And it's a continuation pattern, so we'd anticipate the price continuing on in an upward trend.
Yes, but only if the breakout higher has been confirmed.
At the start, you mentioned a bearish version.
Yes, this is when the preceding trend is down, the pattern forms and the price break below support instead of above resistance. Like I said before, these are fairly rare, but they do happen.
Thanks. Can you show us how traders would trade a bullish ascending triangle, please?
Of course, let's take a look.
Okay, so now that we know how to identify an ascending triangle, how do traders trade them exactly?
Well, if traders see one of these patterns developing, the first thing they must do is to wait for it to be confirmed with the breakout. If it doesn't do that, then it's not an ascending triangle. I cannot stress this enough. Lots of traders trade a pattern assuming it will finish completing. Don't fall into this trap.
Yes, that's understood. We wait for it to break the resistance.
Once the pattern is confirmed, the next step is to assess how significant a pattern it is.
Why do traders need to assess how significant it is?
Well, traders do this to give it more or less weight in their analysis. If you think back to our previous lesson, where we've spoken about duration, this is how long it takes to form. If we are trading in a daily time frame and it forms over 6 months, that's a decent amount of time. If it's a couple of weeks, it's still a continuation pattern, just not a significant one.
Yes, I remember. The longer the period, the more weight traders give the pattern.
That's right. It's the same with the height and volatility of the pattern. If we see the Bollinger Bands widening as the pattern forms, we know there is increased volatility. This adds weight to traders' convictions around the previous trend continuing.
I see. So if traders spot an ascending triangle that is long in duration, volatility has increased and it's broken the resistance, what then?
Traders can use patterns to set potential price targets once it confirms. Traders use two methods. The first one measures the widest vertical distance of the triangle. This is normally where it starts, and The same distance is then applied to the breakout. The second method applies the parallel support trend line to the high of the triangle in the direction of the breakout.
Why do traders set a price target? What's this for?
We'd of course be using other technical analysis techniques to verify the probabilities were in our favor before placing a trade. But by plotting a price target, traders know where they might exit the trade. Remember, these are well-established patterns and other traders will have noticed and traded the pattern. They might be looking to exit when the price target is hit.
In the introduction, you mentioned traders use patterns for risk management. How do they do that?
When trading a bullish ascending triangle pattern, traders typically set their stop loss order below the support line.
Oh, I see. That's useful. That's good. Using a pattern gives a trader a price target and a stop loss area.
Okay, let's show you an ascending triangle on a weekly chart of dollar-yen. We can see the resistance line develop here. There is an uptrend into the pattern. It consolidates and we see several touches on the up-sloping support line.
And when is the pattern confirmed?
When the price breaks above the resistance line, when it's confirmed, traders might set a price target by taking where the triangle was at its widest and projecting above.
But it didn't go on and hit that price target, did it?
No, it nearly did. This one was not a successful continuation pattern. Remember, there are no certainties in trading. It would have been important to set a stop loss. In this case, it would probably be placed below the support line here.
Okay, I understand. That was handy seeing it on a chart.
Let's move on to descending triangles.